Hi, I'm Don Chamberlin. I'm a certified financial fiduciary, which means I am legally bound to act in your best interest. Over the past 2 decades, I've helped thousands of people plan and maximize their retirement income. The truth is, the best retirement income solution is a personalized one. It's designed for you and your life, nobody else's. Learn key strategies to avoid costly mistakes and secure your retirement savings. Ready to define your retirement dreams and make it happen? Let's build your dream retirement together here. Our guest today is a very close friend of ours, Dave Alison. Dave is the president and founding partner of C2P Enterprises. He's also the president of Prosperity Capital Advisors. That is a national registered investment advisory firm that has $4 billion of assets under management. In addition, he wears a lot of hats, don't you, Dave? He has his own practice called Allison Wealth Management that specializes in tax planning. So that's what we're going to talk about today. I'm very excited to have you on the podcast, Dave.
Yeah, Don, super happy to be here. Thanks for inviting me.
So, you know me as a guy who wears glasses, right? You're probably wondering what happened to my glasses.
So I feel like we got a good story coming.
Yeah, exactly. So, I had this really high prescription, right? And my wife and I took our 40th anniversary trip in the Mediterranean. We went on a cruise ship, and I lost my prescription sunglasses in Turkey, in Ephesus, Turkey, right? Then I got back, and the regular glasses I had, the film was starting to come off on the inside of them. And I'm like, I think this is a sign. My sister had gotten eye surgery several years ago, and now she doesn't have any glasses. Well, I ended up doing the same thing. It's called custom lens replacement. And so now I don't have to have glasses anymore, and it removes my possibility of ever getting cataracts too. So I'm super excited. I'd recommend it to anybody.
Nice. That's it's amazing. You remember we were in Costa Rica traveling one time, and I got sunscreen in my contact lenses. And at that point, I think I came home and booked LASIK surgery the next day. It's been amazing. I think I've been off of glasses for like 6 or 7 years now.
Yeah. Well, we were just turning into a health podcast here now, Dave. One of the main reasons I wanted to have you on is Dave and I have been working together for 14 years and really been friends for close to 20. And so he came out with this concept called the tax management journey. It's really advanced tax planning. So let's kind of talk about how you got into this. I know you've been working with a lot of people in the tech industry. Maybe you can talk about your background there.
Yeah, absolutely. I mean, I think kind of my progression into this is like, we always hear these analogies that like these ultra wealthy families have all these like really crazy, robust strategies to minimize their tax bill. And the reality of it is some of them do, but it's not just kind of a one-time strategy. I think like what I kind of observed working with really wealthy families myself and studying what other families were doing is it was almost like a journey that they were going on. It wasn't just like one thing or one strategy that helped them reduce or mitigate their lifetime tax bill. It was just a number of different components that came together. And so, what I started to do was take these different things that those families were doing and really systematize them and build processes around how we could take that same idea or concept to the everyday consumer.
Yeah, just the general public needs that too, right? Yeah,
exactly. So yeah, that was kind of the initial genesis. To your point, I was working with clients mostly out in tech and Silicon Valley, and these clients were making an incredible amount of money, but just like I know you say all the time, it's not what you make, it's what you keep. And
correct.
Taxes are most of our single largest expense throughout our lifetime, and it's not just while we're working. As you're well aware, being such a retirement planning specialist, that taxes stick with you through retirement, and then they say the only two certainties in life are death and taxes. But even when you pass away, your inheritance could be riddled with taxes as you pass that money on to
Right,
your
right.
beneficiaries. And so we really wanted to be able to put some strategies in place that could help our clients keep what's taken them a lifetime to accumulate.
And we always talked about this concept of that there was a fire sale on taxes now. So this is really we're going into a period of time where this Tax Cuts and Jobs Act is either going to expire or be renewed. What's your feeling on that? Do you feel like taxes are still on sale? Do you feel like they're going to go up, down, stay the same? What's the projection for that?
Well, I think for most people, taxes are still on sale and they're probably going to continue to be. I mean, I
Okay.
believe that with President Trump winning the White House, with, the Republicans controlling Congress, I think we'll most likely see an extension of the 2017 Tax Cuts and Jobs Act, which effectively lowered taxes for almost everybody out there. And it looks like those provisions are going to be able to be extended beyond 2025. Because, Don, as you're well aware, under the 2017 Tax Cuts and Jobs Act, a lot of these provisions that impact everyday individuals, investors, retirees, they were supposed to expire at the end of next year, at the end of 2025. Well, I think, the lower brackets, the higher standard deduction, those types of things will probably be here for, at least another 4 years, maybe 10
Yeah.
years, who knows, but we'll start to see how policy unfolds going into 2025 here.
Right. And I think why you're saying it's a fire sale is the history of taxes, right? You think about when we go back and look at tax rates over time, after the Second World War, taxes, the highest tax bracket was around 90%. Throughout the decade of the 1970s, the highest tax bracket was 70% for the whole decade of the 1970s. And today, what is it, Dave? It's like what,
37% is the top rate today.
37. And if the Tax Cuts and Jobs Act expires, it's going to be what, like 30,
39.6.
39.6, right? So with those kind of rates compared to what we've seen in the past, it could be that it's on sale now still, because there's a lot of thoughts that this budget deficit is going to cause higher taxes. I mean, that's what I hear a lot when I'm teaching classes, that people are concerned that these things might go up. But I guess the listeners have to decide for themselves if they think taxes are going to go down, stay the same, or go up, and that's going to reflect in what they do for their retirement planning.
Yeah, I think that's exactly right. I mean, Don, your point on these high marginal rates, they've been a lot higher historically. There were some differences in the tax code back then than exist today, like,
Right.
some of the deductions, exemptions, credits. But the reality of it is we are at a historically low environment from a tax policy perspective. And, most people would believe exactly what you said, that with, the amount of debt that our country has today, taxes have to go up in order to chip away at some of that. But my point was, it's not just the top rates. People think of this number of 37% or 39.6%, or like you said, when it was all the way as high as 92 or 93%, which is,
Right.
the reason that Ronald Reagan would always say, like, I would only make 2 movies a year, because if I made a third movie, the government would just keep all the proceeds at a 90
Right.
plus percent tax bracket. But it's all the rates going on up, right? So if we look at like 2017, the 12% bracket that exists today, which is what drives a lot of taxation for most retirees, was
Correct.
15%, and it would have gone back to 15%, right? And the next bracket, which is 22%, would go up to 25%. So all these brackets were scheduled to go up, and they were higher back in 2017. But it's not just the brackets, it's the amount of income you could have and be within a bracket.
Right. Right.
And
Right.
that's
Right.
what a lot of people miss, is that, for example, if you had $125,000 of income back in 2017, you might have been in a totally different bracket. So it's not just the bracket changing, it's the amount of income you could make and still be in these lower
It's
brackets.
a higher bracket, right? You'd be in a higher bracket and more taxation.
Exactly, exactly.
Right,
So,
right,
so
right.
I think what people need to think about, and this is a message I'm always talking about with the tax management journey, is it's not just whether you think the federal government is going to increase taxes in the future. It's looking at your individual situation. And for most people, they go into retirement thinking, oh, when I retire, my tax rates are going to go down. But in fact, taxes oftentimes go up in retirement. They have Social Security income that's taxed at provisional
Right.
income rates. They're taking withdrawals out of their retirement accounts. That's all taxed as ordinary income. And they lose a lot of their deductions and credits. They might not have child tax credits anymore. They might not have, all the itemized deductions like of a big mortgage interest payment.
Right.
So
House could be
there's
paid off, right?
yeah, exactly. So there's so many things to take into consideration.
So one thing that I really like that you've done is these tax funnels, because it's very confusing for many people in retirement to determine, where do I take my distributions? How are my, because I have different asset classes. I might have some in the bank. I might have some in IRAs. I might have some in cash value life insurance or Roths. And which one should I take first? How is each one taxed? What's more beneficial for me? And, what are kind of some of the trends? Because what we've seen is the baby boomers and Gen Xers were incentivized to put money into tax-deferred vehicles because you got a match for putting money into your 401k, right? So why not take full advantage of that? The problem with that is when you take money out when you're retired, it's fully taxed in your highest marginal tax bracket. So maybe you can go over these tax funnels, how they work, and we'll put up a slide while you're doing this so everyone can visualize what you're talking about as well.
Yeah, that's great, Don. I'm happy to. And, I know you didn't invite me on the podcast to just give the answer of it depends, but I do want to say for everybody listening here, there is no one size fits all solution for how you should take your retirement distributions out of the types of accounts you have. I think that's where
Right.
working with an advisor at Chamberlin Group can greatly help you navigate. But I'll just kind of paint in some broad strokes. I call it the order of money. And there's an order to how you should accumulate money when you're working and accumulating. And when I say order, I mean, when you think about how much capacity for savings you have, how you want to allocate that savings to pre-tax accounts like a 401k, an IRA, how much you want to allocate to tax advantaged accounts like a Roth IRA, a Roth 401k, an HSA, permanent cash value life insurance. And those two funnels, as Don mentioned, the one on the far left-hand side, the pre-tax funnel, and the one on the far right-hand side, the tax advantaged funnel, think of those as opposites, right? They do opposite things. The one on the left side, the pre-tax funnel, as Don mentioned, I always think this is bad terminology too. People will say you get a deduction to put the money into those funnels, right? I don't like the word deduction because that's a little misleading. You get a deferral of the tax when you put money into those funnels. But the reality of it is you got to pay the piper at some point. Unless you're going to plan on giving all your money to charity, you're going to have to pay the tax on that. So for the pre-tax funnel, you're going to get a deferral to put money in. It's going to continue to grow tax deferred over time. But as Don mentioned, when it's time to take money out to supplement your retirement lifestyle, it's going to be taxed at whatever ordinary income rates there are at that time. Now, on the flip side, the tax advantaged funnel, again, think of this as the opposite. You're not going to get any tax deferral to put the money in. So if I earn $10,000, I'm going to pay tax on the 10,000. Maybe that gives me 8,000 left, and I could put that 8,000 into something like a Roth account. That's going to grow tax deferred over time. But Don, when it's time to take money out of that Roth account, how is that withdrawal taxed?
There's no tax due.
There's no tax, right? And it's not just on the amount you put in. there's no tax on all the investment gain that you
Correct.
achieved over that time also.
That's
So
why we like
again,
that funnel the best, Dave.
exactly. The
Right?
best type of money is typically tax-free money. So, but now you might have certain clients that are in the accumulation phase. Maybe they're earning a lot of money. They're in the highest brackets. Maybe deferring does make sense for them. But for other clients, as they're accumulating, maybe they're earning and they're in a more modest bracket, like a 12% or a 22% bracket. And it makes more sense for them to go to that tax advantaged funnel. Of course, the IRS sets limitations on how much you can put in each of those funnels. And the reason the IRS sets limitations on those funnels is they don't want billionaires stuffing all their money into those things, right? The
Right.
government needs money. And so the middle funnel, the post-tax funnel, is where all the rest of the money can go with no limitations. These are like your brokerage accounts, your trust accounts, real estate, anything that doesn't have a tax benefit like deferral or tax-free associated with it. And so when people think about how they accumulate money, they should think about how much they're accumulating in each one of those funnels. And then when it comes time to retire, and this was going to your question, how should somebody think about taking retirement income out? Well, one of the biggest mistakes that I see people make is they spent their entire working career only saving in one of the funnels, right? Don,
Right.
how many times does your team run into a client that 80 or 90% of their investable assets are held up in a 401k or an IRA?
That's happening every day. I mean, people come in from our classes and that's what they were just told to do. And it seemed right. In fact, I remember back in the day, because I started teaching some of these classes in high schools in the late 80s, and we used to teach people that you should put your money into tax-deferred money. So that would be the pre-tax funnel that you're talking about. And the reason you would do that is because you're going to be in a lower tax bracket in retirement. So I've actually had some people come in and talk to us and ask us questions and say, so Don, can you please give me those special tax brackets, the lower ones that I'm in now that I'm retired? Like people in retirement actually get a lower tax bracket because they've retired. No, you get the same tax bracket, right? And that advice that we gave back then, unfortunately, wasn't correct. It wasn't good advice. There were some things that were different back then that made it make more sense. One of which was that Social Security was not taxed back then. But it's totally changed, and people didn't have as high of a lifestyle in retirement. The greatest generation, people didn't want to spend as much money and have as high incomes as let's say the baby boomers and the Gen Xers. So those are the things that, and unfortunately for us as baby boomers, it causes us to have this problem with taxes. That if you continue to keep it in that and just pay it out year after year as you take money out, you're going to pay higher tax than doing tax planning at the beginning of your retirement. Or the other thing is just you could spend down all the other money, right? You could spend down your after-tax dollars, your tax advantage. You could spend those. Then you're leaving a big. You're accumulating more taxes by letting the tax deferred grow that you'll either have to pay in your lifetime or your children will have to pay. So it's a big dilemma. This is why you say it's different for every person, right?
Exactly. And so, I mean, kind of getting back to the foundation, right? If all you've done is accumulate pre-tax money, you're kind of on the government plan, right? Like you don't have any control over your taxes because all of your money is held hostage in this account that is going to be taxed at whatever ordinary income rates are when you take the money out. Now, the good news for you is if you're in that situation with the right planning, you can start to make progress on addressing this issue because the government allows us to do something called a Roth conversion. And so that's where you purposely take some money from the far left funnel, the pre-tax funnel, and you transfer it to the far right funnel into a Roth account. Now you have to pay the tax liability on that. But if you're in a low tax bracket as you enter into retirement, like the 12% or the 22%, strategically, you might want to do that. Because I know, Don, we talk about this all the time with required minimum distributions on your pre-tax money. When you reach a certain age, for some people it's 73, for others it could be all the way up to age 75. The
Right.
government is going to mandate that you start taking a certain minimum withdrawal out of that pre-tax retirement account. And so, Don, I've had a lot of clients that have come to me and said, I know what my strategy is going to be going into retirement. We're a married couple, we're age 66, we're going to turn on Social Security, and then we're just going to live off of our after-tax money for the next 5 or 10 years because we don't want to get hit with a tax bill by taking withdrawals out of our retirement account. And what that will look like is a very low tax liability for the first phase of that client's retirement.
Right, because they're taking it out of the post-tax, right, Dave? And they could even be in the 0% tax bracket by doing that because none of that money's, well, some of it may be taxed, but some of it may be at capital gain rates, which can be 15%. So it could be 0% tax rate or maybe even 12% in the first few years. But you're going to talk about how that changes, right?
Yeah, I mean, think about an adjustable rate or a balloon mortgage, right? Where like you have this really low interest rate locked in for 5 or 7 years.
Got one of those right now, actually. Yeah. I've got a great rate. I'm just worrying about when it comes due because rates have gone up substantially now.
Exactly. And that's an analogy of like retired minimum distributions, because let's say you live on the after-tax money and now your pre-tax money is continuing to grow in the market. And let's say you have $1 million of pre-tax money or $2 million of pre-tax money. Well, the rule of 72 says if we can earn a 7.2% investment return, your money will double in 10 years. So let's say you're 65 with a $2 million pre-tax retirement account, and we average 7.2% rate of return. Now at age 75, you have a $4 million retirement account. And let's say you're living off of $10,000 a month of income. Well, the government's not going to allow you to just take out your $120,000 from the pre-tax. They're actually going to mandate a much higher distribution, probably more like 160,000 to 200,000,
Right.
which could push you into a higher tax bracket. It could also cause a lot of excessive tax on your Social Security benefit. It could create higher Medicare premiums. So it's like you're kicking the can down the road. And as Don, somebody you and I have studied with for a long time, Ed Slott says, it's like the retirement savings time bomb. And this is an example of how starting to plan for taxes earlier will really help the latter part of your retirement. And I know, Don, you have way more clients than I have at the Chamberlin Group. How many times have you unfortunately seen that when your married couple clients retire, maybe 5, 10, 15, 20 years down the road, one of the two spouses passes away, and now you have your client living retirement as a widow? Has that ever happened?
Yes, yeah, that happens. Yep. And so now what happens is we've seen that taxes go up and income goes down.
Yeah, tell me about that.
Yeah, the reason is, Dave, is because, and I'm sure you could talk a little bit more about this as well, is you're no longer in the married filing jointly tax table. You're now in the single tax table. So single filers pay taxes at a much higher rate. In other words, the tax tables, the numbers that you start going up to higher tax brackets are a lot lower, and your taxes will then go up. The other thing that happens is, and we talk a lot about this in our Social Security classes, is you're going to lose one of those Social Security checks. And which one is it? It's the higher of the two that stays, so you'll lose a Social Security check. So you'll have less income and you'll have higher taxes in that particular situation. So that's something that we've seen unfortunately happen. Now, the good thing is that the people that come in and can plan with us and do this ahead of time, we're in a good situation to be able to help them avoid these mistakes, because they are all avoidable if you take the time to plan in advance.
100%. And I call it the widow's penalty. And it can really transform the standard of living that your surviving spouse might be accustomed to, because taxes become a big part of the budget at that point. Like Don mentioned, taxes go up and income goes down. And we have a little visual of a tax measuring cup we use in our tax management journey. If you're married, look at the numbers on the right-hand side of the screen. If you're single, look at the numbers on the left-hand side of the screen. And just visually, you can see like at $100,000 of taxable income as a married couple, you're just barely into that 22% tax bracket. But as a single filer at 100,000, you're well into the 24% tax bracket. And so again, that makes a big difference. And as Don mentioned, it's all stuff that can be planned for. So for example, if I was designing a retirement plan for that client that says, I want to live off the after-tax money first, I might say, well, maybe we should use, in my opinion, one of the greatest tax planning tools that we have, which is the standard deduction. Because for a retiree, specifically over the age of 65, you can have about $30,000 to $35,000 of income be completely tax-free because it's offset by the standard deduction. And then from there, you have another amount of income, another, let's call it 23,000 or so, 22,000, that is subject to a 10% bracket. And then maybe another 60 to 70,000 on top of that, that's subject to the 12% bracket. And so the idea of a really tax efficient retirement distribution plan is you want to start to diffuse the time bomb. You want to start to slowly trickle out some of that pre-tax money at the lower brackets, and then use the after-tax or the tax-advantaged money to take out to supplement any additional income you might need at the higher brackets. And to paint a very simple picture of this, I'll give some numbers. And these are just round numbers. They don't coincide exactly with the tax code, but this is for, explanation purposes. Let's say that, a client wants $200,000 of retirement income. Well, we might take the first, let's call it 125 or 130,000 of that from pre-tax sources. On top of that, you probably have some Social Security income. Let's say that's another 40 or 50,000. That gets you to 160, 170,000. And then for that remaining delta, the difference, the 30,000, that's where we might go into taking a withdrawal from a Roth account, or taking a withdrawal from your HSA for some of your healthcare expenses, or taking a withdrawal from a permanent life insurance policy, or selling some long-term capital gain assets to be able to pay a more preferential rate. And when you blend all of that together, it gives you the most amount of retirement income with the least amount of income taxes. And I think that's the goal of most of us, right? We want the highest income with the least amount of taxes.
Yeah. So I've been using this as a tool for many years, Dave. And before the pandemic, I used to teach classes at University of Missouri, St. Louis on the whole concept. There was like a 2-night class we would do. It was very in-depth into taxes, of getting into the 0% tax bracket when you're in retirement. Now, this is not something that's possible for everyone to do, but it's worth a look for most people. For example, if you have a pension, that's going to be taxable. That might cause you to have to automatically be in the 10 or 12% bracket in this example. But other people that don't have pensions, this can work for if you do the right type of tax planning. And the key to it is, you have to, like Dave mentioned, it's the standard deduction. If you can get your required minimum distributions and all other income to be within the standard deduction or below the standard deduction, you will pay zero taxes throughout your retirement. And that's something that we had people that want to go on that journey. And we're going to talk about a little bit more about your roadmap for the journey too. That's something that is possible for those people that want to look into it.
And Don, I want to just reiterate the importance of that, because even for high net worth and ultra high net worth clients, like maybe we can't get you to zero, but we can get you to a pretty low rate. And Don, you mentioned kind of the roadmap. Like when I think of tax management and when I mapped out the 7 steps that I was seeing the wealthiest and most sophisticated families implement, the first one started with understanding this order of money, which we've spent a bunch of time on already.
Correct.
How to accumulate money, how to reallocate your money in those 3 funnels, and then how to take distributions from your money. The second was measuring your bracket each and every year, because the United States tax system is a dynamic pay-as-you-go system. We all know the more income that you make, the higher your taxes. But it's not just the more tax you pay, it's the higher the marginal rate. And there's so many opportunities within the brackets. For example, one year, you might have a little bit lower income need or withdrawal need, and you might be in that 12% bracket. Well, one of the biggest mistakes I see people make is they don't fill up the bracket, because the tax system is a use it or lose it. If you don't fill up the bracket and take advantage of that 12%, you could never go back and take advantage of that low bracket in a future year where maybe you're in a higher bracket. So you want to be managing your brackets and measuring your brackets each and every year.
So is this what we call bracket bumping, Dave?
That's one of the techniques, bracket bumping, managing your bracket. There's also capital gains harvesting, right? So there's something that a lot of people don't realize, that if you structure your income properly, you could realize some capital gains at a 0% tax rate. So there's a lot of basis management techniques if you have that middle funnel of post-tax. So there's so many opportunities within measuring your bracket.
Dave, we really appreciate you joining us today and giving us all this wonderful information on taxes. I'm just finding out from what you're sharing with us, the taxes are even more complicated than we've ever thought, but there is a solution. So thank you very much for joining us today.
Thanks for having me, Don.
Okay, and we'll see you all again next time on the Retirement Planner podcast. Please join us for more podcasts. And included with this podcast, you're going to see a link to set up a 20-minute phone call to get any of these questions answered about taxes, find out more information with one of our educators. So take advantage of that. It's free to you, and we're happy to continue your education in retirement planning. Until next time, we'll see you again then.